Good question. Foreign exchange is very different from others in that there's no true bull market and no true bear market. So the euro dollar has dropped from 1.4 US dollars per euro to 1.11 over the last 7 months, and you'd say, well, that's certainly a bear market, it's absolutely collapsed. Well, no, it hasn't, because the US dollar has strengthened. Foreign exchange is always relative. It's always relative. So a lot of analysis that one would do and theories that one would use don't work. And I personally feel that Elliott wave does not lend itself to foreign exchange precisely because of the relativity of the prices that you're looking at. Also, remember that some people quote currencies as units of currency per US dollar. So, for example, the Canadian dollar, that's how we do it in Europe, yeah? CAD per greenback. In North America, they actually quote it the other way round as US per CAD. And so then what happens at the bottom of a market or what happens at the top of the market, you're going to be looking at things differently depending on how you're quoting it, right? You're also looking at things differently because traditionally at a peak of a market, moves become more jagged, more extreme, more vicious. And at the bottom of the market, and it's to do with the law of tiny numbers, moves get terribly, terribly compressed the closer you get to zero. Foreign exchange, that is not the case. You don't get to zero. You don't get big. One person's big is another person's small. And then the other thing is that it's not exchange traded. You don't have very much idea of who's doing what the big boys are doing. You have very little information. You don't know what the volume's like. You just have very little input. And that's the problem with any over-the-counter market. So the same will go for corporate bonds, which are all traded over-the-counter, although, well, nowadays a few more machines are doing it, but you don't get the data. You just don't know the data. You don't know who's doing what. Foreign exchange affects the value of everything you have, might have, and want. So let's start there. Foreign exchange is absolutely vital in everybody's existence. Okay? You might have a currency that's extremely strong, and then you go on holiday and you have a fabulous time and you think that whatever, living in Jamaica is dirt cheap. Okay, right? Other times you have a currency that's inherently weak, that they're trying to control it, that's riddled with inflation and all the rest of it, a la Venezuela, Argentina, Zimbabwe, and a few others along the way. Okay, so without even trading, you can see already that foreign exchange affects dramatically the value of everything. You, your companies, your country. So that's why it matters so much. From then on, if it's such a big market, no wonder people trade it actively, and there's a lot of money going through for all sorts of different reasons, of which speculation is just one part. There are very sound reasons why you would want, you know, as an exporter to hedge your exposure for your receivables coming in later that year and all the rest of it. So there are very, very solid economic reasons why you would definitely want to get involved in the foreign exchange market. Also, because of this, the swings in the FX market tend to be relatively large, because it's so important to so many people, relatively large. And so that's why you will find that it's worth speculating in. In other words, the price moves are big enough to make it worth your while to attempt to make money out of it. Unlike, say, housing or something like that, commercial real estate, you can't flip it just like that, and it's not going to make much more than 10% in a good year. Do you know what I'm saying? And so it doesn't have that impetus in terms of your trading.